This is a recording of Financial Myth-Busting with Don Bennett for Sunday, June 29th, 2014. You can listen to this program live every Sunday morning from 11 a.m. to 12 p.m. right here on 105.9 FM and AM 630 WMAL.
Securities offered through Western International Securities Incorporated, member FINRA SIPC. The views expressed on this program do not necessarily reflect the views of this station. Proper advice depends on a complete analysis of all facts and circumstances. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.
You're listening to Financial Myth-Busting with Don Bennett.
It might seem crazy what I'm about to say. Sunshine, she's here, you can take a break. I'm a hot air.
This is Don Bennett with Financial Myth-Busting, and yes, we are live today. It was a very interesting week last week, and I have to tell you, my takeaway for the week was that nothing really seems to add up. So that's what we're going to be talking about. And to remind everybody that we are live. If you have any questions about your portfolio, feel free to give me a call. I've been a money manager for 30 years, and I'm at 1-855-884-DAWN, and that's DAWN, and that's 1-855-884-3296. And if you want to become a fan of Financial Myth-Busting, just like us on Facebook at Financial Myth-Busting or follow us on Twitter at Don Bennett FMB on Twitter. And also, the bottom of the hour, we are going to have Frank Keating. He's the president and CEO of the American Bankers Association. And we're going to be talking about why small community banks are dropping like flies. It's like these local banks are on the endangered species list, and I'm going to be asking him about that directly, as well as to remind everybody that Financial Myth-Busting is now syndicated, and it's going to go national. So we're not going to do it through the radio station we're doing here. We're doing it through a company called radioamerica.org. So if you go to their website, you'll be able to get the different stations in the different cities that we're going to be airing in. And we're really super excited about it. And we're also going to go from a 1-hour show to a 2-hour show. So this should happen sometime, we think, mid-July, end of July. But if you don't catch up with one of the radio stations, don't worry. You can always catch the podcast of our 2-hour show on financialmythbusting.com, which is our website. And again, you just need to go to the archives to financialmythbusting.com, and you'll be able to get the podcast of our new 2-hour show, or even any old 1-hour show that we've done, including this one today. So before I jump into my takeaway for the week where things just didn't add up, I want to ask you this question. Do you think that the U.S. is in an economic recession? I mean, the National Bureau of Economic Research said recession ended in June 2009, but there are so many Americans out there that think we have been in one and still are in one. Do you? I'm at 1-855-884-DAWN, and that's 1-855-884-3296. Or are we in some sort of invisible depression? I mean, 1 out of every 5 Americans are now on food stamps. And if they weren't getting food cards in the mail every month, you'd see these super long soup lines out in the road. So know this, experts always argue whether we're in a recession or not, and they always seem to deny them. And then they always seem to be surprised by them, even though recessions have occurred every 4 to 7 years since economic record keeping has ever begun. So a recession is the downside of a business cycle. Everybody knows what that's like because we get affected by it. Your pay gets affected by it. Your bonus check or lack of bonus check gets affected by it. Employment gets affected by it. On the upside, when things are great, factories are running near full capacity. Well, we don't have that in this environment. And unemployment falls. We don't have that either. Unemployment's going through the roof. And inventories are low because customers are buying. And we also don't have that because the American consumer isn't buying. They're tapped out. And the other thing that is a very big indicator is that your economy, when you're in a non-recessional time, is growing with a positive GDP report. And we don't have that either because they just revised down our GDP for first quarter 2014 to a negative 2.93%. Negative. So during recessions, everything goes the other way, and we seem to be in that other way. But here in the United States, it just seems like we're always denying them even after the fact. It's like we're dreaming up of a never land of eternal upsville. And that's about as foolish as denying winter is coming. I mean, I've seen this happen. We spend the time arguing why the Indian summer is actually going to continue forever and that spring is right around the corner and we're just going to skip over winter. So we never put up the storm windows or we never put on the snow tires. And, people who do that are always wrong. It sets us up for a very, very uncomfortable winter. So here's what I'm asking. And this is what I'm saying. No one can predict exactly when a recession or a depression starts any more than one can predict exactly when the first snowfall is going to happen this winter. But I think it's probably time to bring in the firewood, right? And cut financial risk in your portfolio so you can be prepared. What do you think? I'm at 1-855-884-DAWN, and that's 1-855-884-3296. I want to hear, do you think we're in a recession? And if we are, guess what? I want you to tell me what you're doing about it. So, let me move on to what my takeaway for the week was, where I said it just doesn't seem to add up to me. You know, U.S. stocks, of course, surged this past week. I'm on the absolute worst economic data we have had in 5 years. And, of course, front and center to this week's horrible economic data points was the U.S. GDP. Now, that's the gross domestic product for first quarter. It was revised from a negative 1.0% to a negative 2.93%. And the U.S. markets just took off like a rocket. Even though this is the worst quarter of growth in almost 60 years. I mean, just imagine how strong the rally would be if the U.S. GDP had been revised down to a negative 4% or even a negative 5%. I mean, all kidding aside, though, if the collapse of the U.S. GDP doesn't send the S&P lower, then it feels like almost nothing will. And that's a trap. So you need to be asking yourself or stating to yourself, this just doesn't add up. And you're right, it doesn't. But I think there's an explanation. You know, last week we talked about how the central banks were putting in $29.1 trillion so far into equity markets around the world, and primarily in the United States markets. Our Federal Reserve has been doing that. It's an unconventional monetary policy, never done before, and they can't seem to stop. I do think that's one of the things that's holding up the market for all the wrong reasons. But the other thing is that investors get trapped into something called a herd mentality. And, you know, herd mentality or herd behavior in investing is a fundamental element of free markets. And because we have always had herd mentality in the marketplace, many a times investors have followed the herd right off a cliff. I don't care how smart they've been. I've seen it. After 30 years, I've seen some of the smartest guys just follow because they think they're missing something. Unless a few of those investors become aware something's going to happen, which means herd mentality can be turned into herd wisdom, and an investor can be turned around. And you want to know what else? That means financial crises can be predictable if you face the facts. You know, an investor should always keep his feet on the ground. Stay very aware, because you don't have to participate in the next financial crisis. Just remember, financial crises are not unpredictable black swans. And as human beings, it's entirely acceptable to be optimistic about the future. However, optimism and pessimism are emotions that tend to bias critical thinking. And you need critical thinking in order to effectively assess the risk. So, you know what I want you to do? I want you to listen to this clip. And you're going to need your critical thinking to get through it. And you need to somehow stay straight. Now, this is CNBC's Brian Sullivan last Wednesday. He appeared on MSNBC's Morning Joe, where he reported on the revised GDP and said that it really was the weather at fault and that people should be optimistic. Again, he's blaming the negative 2.93% GDP on the weather. Take a listen.
It came in initially as a negative 1% contraction. They've revised it down to a 2.9% contraction for the first quarter.
So that's almost a 3% decline in the economy in the first quarter, a lot of it weather-related. How does that stack up, though, historically? That sounds
According to Dow Jones, just looking at it now, Joe, it's the biggest non-recession quarterly drop in 58 years. Whoa. But you brought up the key word, the W word. Here's the thing, weather. I know people like to blame everything on the weather. John, you were just making a good point. This quarter really actually was horrible. Mm-hmm. Like you couldn't, people didn't go to restaurants for weeks. So we're waiting to see what happens, with the second quarter and whether we're not going to completely sharply rebound.
Remember, you need to stay straight. And critical thinking means no emotions. You're hearing from them that they say this is an anomaly, and they say this is the biggest non-recession quarterly drop. Again, your job is to effectively assess the risks. Here we go. First quarter 2014 GDP was not a weather-related anomaly, even though you heard it in this clip and in the media everywhere. So don't emotionally skew it that way. A negative 2.93% GDP means that this consistently printing the dollar Fed won't be able to support the fairy tale that both Yellen or the White House have been telling us. Now, for historical perspective, and you need that, there's been 265 quarterly GDP prints since 1947. 265 quarterly GDP prints since 1947. And on 18 of these, they posted a number below negative 2.9% recorded for first quarter. And here's the kicker. In only one of these 18 deep down quarters was the U.S. economy not in a recession. So, my best educated guess is that we are in a recession. And no matter what propaganda the media or government or even Wall Street wants to spin your way, and part of that propaganda is that the Federal Reserve has come out and said that they anticipate a positive 1.5% GDP for 2014, just know that we have a remaining 3 quarters to get there. And the only way we could get there in those 3 quarters if we average 3%. And you know what? That's just not going to happen. Even if hell freezes over, it's just not going to happen because so far, none of the components that make up the second quarter GDP are in any kind of fast-moving upward movement. I mean, they literally would have to be on an Olympic-paced sprint to get us there. Let me give you an example. Housing starts for second quarter are actually below first quarter after the first 2 months of second quarter. Housing starts fell 6.5% in May from April while holding just above a seasonally adjusted annual rate of 1 million. The April rate was 1.07 million. So, again, that's worse. And this kind of data doesn't exactly cause us that kind of assurance we need to think that the economy is getting better and we're going to hit that positive 1.5% GDP for 2014. Likewise, real fixed business investments have been decelerating over the last few quarters, and there's absolutely no indication of reversal. Even the PCE, which is the personal consumption expenditure, now this measures all goods and services consumed by Americans and is a component of the GDP, it's also doing poorly. After 2 months into the second quarter 2014, the PCE is not even at or ahead of first quarter 2014, which means U.S. consumers are not buying products. They are not spending money. They are tapped out. So this narrative that we're hearing everywhere in the media that the consumer is back, it's just downright wrong because it is belied by fact. Here's more. Durable good orders tumbled 1%, which is so far the biggest miss in 2014. That came out last week. And even on a year-over-year basis, durable goods are negative, all of which is not great news for second quarter GDP. So the truth of the matter is that it seems we are now living on borrowed time. The U.S. GDP is the worst it's been in 5 years. U.S. employment participation rate is the worst it's been in 37 years. The U.S. food stamps recipients are now over 50 million Americans on food stamps. And in between and in betwixt all this, the S&P 500 hits a new high. That's right. It just doesn't add up, which means all investors need to ground themselves and remember the crash of 2008, because just like back then, there were harbingers of the correction to come. And right now, I'm advising all of the investors at Bennett Group to be cautious because there are plenty of signs coming from both the market and the economy that indicate vigilance is a wise choice at this time. Remember something, you need to pay attention. And if you do pay attention and you protect yourself and you hedge yourself, then your portfolio won't have to drop 35 or 50% like it did back in 2008. I know what you're up against. A lot of people are telling you hold on to the stocks for the long term. But you know what? If these markets correct and there isn't much to push it back up again, except for Federal Reserve money that they're printing or any other central bank's money that they're printing and they can't do it forever because it's destroying their currency, then that isn't something I would actually bet on in the portfolio. And when we get back, we're going to be talking more about if we're in a recession or if we're in an invisible depression. This is Dawn Bennett with Financial Mythbusting, and we'll be right back.
This is Financial Mythbusting with Dawn Bennett.
And you know what? I want to hear from you. Has this ever felt like a recovery in the economy? Or do you think that the U.S. government twists the data just enough to show growth? But you know what? The truth lies with you. Give me a call at 1-855-884-DAWN, and that's 1-855-884-3296. I mean, here are some alarming stats. There's more than 50 million people on food stamps. 26 million Americans are either unemployed or have given up looking for work. 11 million Americans are claiming disability payments, which is effectively a new form of unemployment insurance. And you know what? What's your impression? I mean, has anything ever positive happened to you since they said we are in recovery? Give me a call at 1-855-884-DAWN, and that's 1-855-884-3296. And I will take Daniel in Virginia. Hi, Daniel.
Hey, Dawn.
Hi, what are you thinking? Are we in a recession, or are we in some form of invisible depression?
I don't think it's invisible at all. I think we're in a full-on depression. I think the mainstream media and the government are trying to sugarcoat everything, and we've got an election coming up in November, and the current running party is trying to pad the top so that people have faith in the government. But the economy is very visibly struggling.
And Americans are visibly struggling. Yeah, and Americans are visibly struggling too.
Absolutely. I mean, businesses struggle, therefore people struggle, and I mean, to have 50 million people on food stamps and welfare and all this other stuff, we're giving up our freedoms by allowing the government to do nothing to improve the way of life for Americans.
So has this affected you in a negative way? I mean, or if you had anything positive happen since, the government was saying we've been in a recovery?
Absolutely nothing positive. I have, it definitely hasn't. It hasn't hurt me, but to the point where, I used to put money away every month, and that's non-existent.
Yeah.
Now I worry about the fund that I have set aside for emergency situations, and I'm not adding to it.
Right.
It's impossible to sacrifice. I'm sacrificing everywhere I can, and I'm still not putting any money away.
Yes, and you're probably afraid that you're going to be running through that money just in case something difficult happens.
Exactly, and I just my investments I've pulled off the market. They're sitting in limbo, waiting for what I expect to come soon.
Yes,
I think it's going to tank, and I think it's going to tank pretty hard.
Let me ask you one more question, Danielle. When was the last time you got a raise? Was it 3 years ago, 4 years ago?
About 3.5.
Yeah. That seems to be what we hear from everybody, including our clients. I mean, there just absolutely is no increase in income. I want to thank you so much for calling, Daniel. Your insights are invaluable. We've got Robert in D.C. Hi, Robert. How are you?
Hi. One of the things you see a lot of times on these talking heads, especially on CNBC, is they tell you that the S&P, I guess the PE ratio, whatever it is, is only around 16 or 17, and that compared to 2001, where it was before the tech crash, where it was 20-something.
Right.
But I know they never mentioned 2008. And I'm curious because, I've never known the PE to be a reason why people buy or sell. It's always a function of fear and greed. No matter what the PE is, people are going to sell and buy regardless.
Yeah, so here's the thing, Robert. Actually, we've actually kind of talked about this every once in a while on my show. PE ratios are probably not in fashion, so to speak, because I just don't think that many people buy stocks anymore on PE ratios. It's just not as relevant as it used to be. Now, again, I'm not giving a pass to any of the media who don't disclose everything that they need to disclose about, but I think you're right. I mean, right now, the PEs, if you were to use it as a measurement, is so ridiculous. But the sad part is that I mean this. Americans are so desperate, they're just diving in head first, thinking they're missing something, like the grass is greener over there, and they got to get there. And I mean, smart people. There's just really this really underlying insecurity that's showing up, and I see it in investors all over the place, and they just. They really need to think this through, and like I said, they need to have critical thinking in order to survive it.
Well, I guess my only conclusion, right, I said, I'm curious, they never give the background of some of the people on these talk shows, so I was wondering who's managing money and who's not. I guess if I was managing some of the money, the last thing I would say is something that would cause my clients to leave.
Well, you don't have to cause your clients to leave. You can always do something different. I mean, I think the job of a financial advisor is not to manage in the past. It's to manage in the present and for protection of what's going to be coming in the future. And so a lot of people do have an odd agenda when they come on board. So you have to be careful of that. Remember, though, your financial advisor is there to help you when things are easy and the markets are going up. And right before those markets go down, their job is to try to stop you from declining doing so much. Robert, I want to thank you so much for giving me a call. Everybody, make sure you stay tuned because we have Frank Keating. Again, he's the president and CEO of the American Bankers Association, and I'm going to be asking him if local banks are on the endangered species list. This is Dawn Bennett with Financial Mythbusting until we get back.
This is Financial Mythbusting with Dawn Bennett.
And Frank Keating is here. Frank is the president and CEO of the American Bankers Association, which is a 135-year-old group that represents banks of all sizes and charters. Now, Keating became ABA's president and CEO on January 1st, 2011, following 7 years of service as the president and CEO of the American Council of Life Insurers, and after serving 2 terms as Oklahoma's 25th governor. On June 20th, 2014, Mr. Keating was interviewed by Bloomberg, where he stated that excessive regulation is strangling U.S. community banks, which have closed at the rate of about 1 per business day since 2008 financial crisis, and that community banks spend about 15% of revenue on compliance, even though they weren't responsible for the credit crisis. And this is where I want to start today. Frank, welcome to Financial Mythbusting.
Thanks, Don. It's an honor to be on.
Let me just ask you straight out, are local banks on the endangered species list?
Well, the numbers of local banks that we've lost would suggest that something is very seriously wrong. And it's the bankers' view that it's excessive regulation. For example, Dodd-Frank, 7,000 pages of proposed and final rules, wasn't supposed to apply to the smaller institutions, but it does.
Yeah.
Basel III, which is a European construct requiring certain capital levels for certain types of assets, and that was not supposed to apply to community banks at all, only the big international banks, and all of it applies to community banks. So that figure that you quoted, 15% of operating income going to compliance, that's fewer people for marketing, fewer people for provision of loans, and the average community bank, Don, has 37 employees. So imagine if the restaurant that you go to for lunch or occasionally for dinner, 15% of its operating income had to make sure that they are in full compliance with the City of D.C. health inspectors, right, and they're in there all the time inspecting. So 15% of your people have to be currying to them and not to your customers. It'd be pretty grim.
Yeah. Why are the Dodd-Frank regulations treating the small community banks and credit unions as the same as their large multi-million-dollar revenue Wall Street counterparts?
I think because the regulators key off the Fed, the Federal Reserve Board, and they're the 800-pound gorilla. Yeah. And the regulators key off the Congress. And their view is that, gee, I guess that we have to be hard down on everybody, not just the largest institutions. And you think about the number of young people, Don, today, 1 out of 3 are living with their parents, people who live under 30 years of age.
Right.
And so many of them, when I was 27, I bought my first house. Today, our estimate is it'll be anywhere from 37 to 40.
Can you
because
imagine
there's a
that?
rule that's, again, part of the Consumer Financial Protection Bureau, which was created under Dodd-Frank, that you have to meet these very strict guidelines in order to get a mortgage, no more character loans. So that chills lending. So where does the money go? For compliance and not lending. And that's just tough because you can't get an economy going if you don't have the people who make the loans in a position to make the loans.
Now, Dodd-Frank seems to be an expensive program to implement, as you've stated, but our economy is continuing to get weaker and weaker. And for the bigger banks, I'm not saying the cost doesn't affect them, but it does seem to roll off their backs. The smaller community banks, however, it just seems to be harder to absorb. Do you have any solutions for these smaller banks?
Well, obviously, what we try to do at the American Bankers Association and the leadership of our association, 90% of our members are $1 billion and less in assets. We have all the large and regional institutions as well, but we're trying to partner together to have the larger institutions in the cybersecurity space, for example, share their ideas and technology suggestions with the smaller institutions. But it's a perfect storm. We talk to the regulators frequently. They assure us that they have small bank, community bank programs. They're looking at this. They're trying to address it. But for the first
do they
time
have
ever,
them?
Don,
Do they have them?
Community bankers who banks have been in their families for 2 and 3 generations saying this is just too hard. We're going to get out. And that's not good because small communities blow away if there is not a community institution in that community. That means Maryland, Virginia, obviously the district is different, but that is not good. You want to have access to credit from as many different and varied institutions as possible. But we're now, for the first time, the number of community banks in this country are less than they were in 1890.
My gosh. Can you remind all the listeners of Financial Myth-Busting why a small local bank is so valuable to the community?
Well, because the larger institutions, A, in many cases, don't serve a small community, and B, even if they do, frequently loan decisions are made by people far, far away. So if you and I had a flower shop in a small town in Iowa or a small town in Maryland, or we had a car wash, for example, somebody in Atlanta or somebody in Dallas would say, we don't do car washes. I mean, that's a terrible investment. Or florist, I don't know anything about that town. So, in other words, the underwriting has to be done in the community. And like my grandfather owned a small community bank, a national bank in southern Illinois, and my twin brother's been a community bank CEO in Tulsa, Oklahoma forever. They know their market, they know their community, they make loans to their market and their community, and they're just a partner to the town. And I think that it's really important to understand the big banks weren't in the smaller towns and cities, let's say 20, 30 years ago. It's wonderful to have them there, those that do go. But absent them, it's going to be very difficult to find lending opportunities when you have a small community that does not have its own institution.
So my personal money, my corporate money, all is with a community bank. It's with a small bank because that's how I started. They were the first ones that actually gave me a loan. The big guys wouldn't do it.
Well, see, that's an example. They probably thought, well, I'm the big guys, well, that's fine. I'm sure you have a good idea. But character loans, like the loans that my brother and my grandfather made, in other words, I know you, you know me, yeah. You say, I remember you through my paper.
Right.
Those days they had paper routes. And, yeah, you were really a conscientious young person. I'm going to give you a break. That's fine. That happened to me when I bought my first house. I flunked the credit analysis because I hadn't been working long enough. And the banker said, well, you know, have the owner collateralize the first X number of dollars, and I trust you. I think you do a really good job. You'll try to pay us back, and I'm going to make a deal with you. Well, the owner did collateralize the first $5,000. Today, Don, that's not a qualified mortgage loan. Right. Having dad or mom co-sign or having the owner, seller collateralize or co-sign, that's not a QM loan, so it wouldn't be made. I just think it's really unfortunate that this next generation of young Americans saddled by student loan debt, artificially onerous qualified mortgage rules, a soft economy, right. They're all being frozen out of what for you and me and for others is the first step on the capitalist free enterprise American dream, and that's home ownership.
So if we want to get things back on track, what suggestion do you have, or what suggestions does the ABA have?
Well, we, of course, are very, very hard down on amending the Dodd-Frank Act. I think in the House they're willing to do that. In the Senate, not so. They're afraid if they open it up to a few amendments, it'll be a landslide of amendments. But I saw Barney Frank several years ago before he left the Congress, and he said, well, give me some examples of stuff that this is when I first came aboard the ABA, of things that need to be changed. And I said, yeah, to register as a municipal advisor if you have a relationship with a municipality in your bank. My twin brother is chairman of the utility board in Tulsa. He's serving at no compensation. If he leaves, there'll be somebody with less financial acumen on that board. And in his case, if he has to take a course and he has to be registered by the SEC as a municipal advisor, he won't do it. He'll just drop off the community. And Frank, to his credit, said, that's a good point. Yeah, write that down. Had one of his guys write it down. I mean, this isn't the New Testament. There are a lot of pieces to Dodd-Frank that ought to be amended, but Congress just doesn't have the intention, maybe it's the way, to do it right now. And like Basel III, why in the world do banks other than those in the international banking marketplace have anything to do with something that comes out of Brussels?
Right.
But every small bank from sea to shining sea, they're getting out of the mortgage servicing business, for example, to take care of us as as mortgagors, make sure our payments are applied appropriately. They're getting out of that business because they have to have all these new capital levels required by Basel III. It really makes no sense. We need some common sense regulation, and we need common sense from the Congress to have hearings.
So 4 years into Dodd-Frank, more than a dozen Washington area banks, we'll just talk this area, and credit unions have merged with one another. And, of course, they're citing the heightened regulation as a factor. Do you think this type of regulation has created a confusing situation for the entire industry, or is it just the small banks and the unions?
I think the regulatory burden, to your earlier point, as hard as it is on the large institutions, they can handle it. Yeah. But the smaller institutions with 37 employees, I mean, how do you read 7,000 pages of proposed and final Dodd-Frank rules? In the mortgage space, for example, there have been 4,000 pages already written by the Consumer Financial Protection Bureau. We have another 2,000 pages coming. Well, who can do that? We at the ABA provide courses and all to help people. But after a while, you just say, this is oppressive. This is nuts. I mean, how many Danielle Steele or Dostoevsky novels is that, stacked one upon the other? That number of pages is just completely suffocating.
Now, this past week, you wrote a piece in The Hill about credit unions. And you described how professional athletes and other high net worth individuals are actually now taking advantage of credit unions. And, you know, I'm just wondering, are the loosening regulations on the banks going to affect the credit unions, or is it going to be the other way around?
Well, they have the National Credit Union Administration is their own federal regulator. But what we in the banking industry object to is the regulator and the regulated. They're locked in our arm in arm. And in the case of the National Credit Union Administration, recently they agreed tentatively, that is through preliminary approval, to a credit union focused on serving pro athletes. I mean, the credit unions were established in 1934. The purpose was to provide bank access, if you will, lending access to people of small means. That's the exact language of the statute. People of modest means, low-income people. I mean, what does LeBron James have to do with people of small means? I mean, the average NBA person this year made $4.5 million. Right. The average baseball player, $3.9 million. Football, $2 million. Hockey, $2.4 million. And what the credit union administration is doing is saying, yeah, you can have a credit union subsidized by federal taxpayers. Credit unions pay no federal income tax.
Wow.
You and I pay more federal income tax than credit unions do, and yet their charter demands that they deal with people of small means. They do it very rarely, and they have huge lending operations for boats and office buildings. That is not the purpose of the credit unions when they were created in 1934. If they want to get into the big leagues and make big league loans like banks do, then pay taxes like banks do. It's just not fair.
I'm going to change tracks here on you. Sadly, this week we saw first quarter GDP get revised down even further south, all the way down to a negative 2.9%. I'm wondering, are you seeing anything in the banking sector that could explain the slowdown? I mean, are people taking out loans? Are new projects being started?
Well, the number of startups is very worrisome. It's very low. I think part of it is a soft economy, regulation by banks, but also what small business is facing in terms of their health care costs and tax increased potential. So people always embrace, they always avoid pain before they embrace pleasure. So it's understood that there will be a softening of interest, if not a softening of demand. Obviously, the weather had an impact, but just think how many months you have to have significant growth to make up for a 2.9% contraction in the first quarter. That's just terrible. And I think, I work for President Reagan, and I have a different view of the economy. I think if you really want to get the animal spirits going, you need to encourage a marketplace of assets, liabilities, purchases, and sales that encourages capitalism and free markets, a reasonable regulatory system, and low tax rates to encourage people to invest and save. And we're not seeing that. I think there is a lot of concern at the present time about how the economy is healing. Certainly we're healing, and thank goodness. But I think part of that is in spite of the government. Part of it is just America is by nature a capitalist, free market, free enterprise society. We just need to unloosen the tethers and get the economy moving, and we're not doing that.
We're not. Frank, I want to thank you so much for being on Financial Myth-Busting and sharing part of your Sunday with us. We really appreciate it.
Oh, thank you for having me on, Don, and all the best to you.
Likewise. And when we get back, we're going to be talking about Gazprom. I've talked about it a couple of times because we are seemingly going through this de-dollarization worldwide. I'm going to tell you about something that happened this past week that is stunning. This is Dawn Bennett with Financial Myth-Busting until we get back.
WMAL-FM Woodbridge, Washington. WMAL Washington. WRQX HD2, Washington.
This is Financial Myth-Busting with Dawn Bennett.
So a little bit, I guess about a month ago, a little bit over a month ago, I announced on Financial Myth-Busting that there was this holy grail gas deal with Russia's Gazprom, that's their gas producer, and China. And it was signed, and this agreement between these two countries were meant to break the petrodollar stranglehold on the rest of the world. Yet, during that time, both countries admitted that they were very eager to move away from the U.S. dollar as the U.S., as the international reserve currency of choice, and the petrodollar, because that's the way it's been since the 1970s. But actually, neither was able to provide an alternative then. But that was a month ago, and last week, Gazprom CFO came out and uttered these magic words that Gazprom is actually ready to settle China's contracts in the yuan, which is their currency, or the ruble, which is the Russian currency. So let me just translate that and what it means to you as an American who does all their business and invest 100% in the dollar. Once the bilateral trade occurs in rubles or the renminbi, which is also the yuan, is established, the rest of the energy world, I'm guessing, is actually going to piggyback because it's too vulnerable having one currency as the international reserve currency of choice. So the dollar is actually getting replaced with rubles and the yuan. And my thought is, gold, anyone? Look, it's no secret out there to everybody that our economy is doing poorly. And remember, to be the international reserve currency of choice, you have to have a strong economy and a strong political system, and they just don't think we have it. And as much as I love this country and you love this country, it's important to, again, through critical thinking, to actually decide what is the best thing for you to do. And so we encourage everybody out there to consider adding gold and silver to their portfolio. And we're just reminding everybody that if you're interested in purchasing it right out, gold and silver coins or bars, you can actually do that through my company, Bennett Group Financial. All you need to do is call 866-286-2268, and you can talk to one of our associates, and we can put it in an IRA. We can store it for you at a top-tier bank, and or you can actually have it delivered to your personal residence. So, again, that's 866-286-2268. And if you're interested in purchasing gold and silver coins, because this Gazprom deal with China is an indication that the dollar may not be the primary international reserve currency of choice in the future. One other reminder is that we are having a seminar on July the 31st, and we actually had a change of plans. We're going to be doing it in the Bethesda, Chevy Chase, Maryland area, and we're going to be serving actually a steak dinner. So if you're interested in attending that, again, give us a call at 866-286-2268. You need to RSVP. And or you can do it the old-fashioned way and email us at info@BennettGroupFinancial.com. And again, it's July 31st. It's at 7 p.m. And when you give us a call, we'll let you know what steakhouse to meet us at. And we're going to be talking about retirement, survival, and how to organize your portfolio to go through a correction. Because I do think we're on the precipice of one of the greatest retirement crises in the world. And I think the impact that's going to be on us is going to be tremendous. Until next week, this is Dawn Bennett with Financial Myth-Busting, and you know what? That's all I've got. Where politics and the economy intersect, that's Financial Myth-Busting.